Market sentiment, it's the heartbeat of every Forex move. It's what makes traders bullish on the dollar one week and suddenly bearish the next. But how do you actually measure it? Today on FX Limit, we're diving into the top 5 indicators for gauging market sentiment in Forex trading. Whether you're a seasoned trader or just starting out, these tools can give you a solid edge in understanding how the crowd is feeling, and more importantly, what they're about to do. Let's start with a classic, the Commitment of Traders Report, or COT. This is a weekly publication from the Commodity Futures Trading Commission showing the positions of institutional traders. While it's delayed data, it reveals the behavior of large players, hedge funds, commercial hedgers, and more. If you spot a major divergence between institutional positioning and market price, you may have a powerful contrarian signal. Next up is the Fear and Greed Index. Now, this isn't a Forex exclusive tool, but it captures sentiment across financial markets. It's driven by indicators like volatility, safe haven demand, and market breadth. When fear dominates, traders flock to safe assets like the Japanese yen or Swiss franc. When greed takes over, higher yielding currencies become more attractive. It's not just emotional, it's actionable. Third, on our list, the Volatility Index, also known as the VIX. Though it tracks volatility in the S&P 500, it has a strong influence on global risk sentiment. A rising VIX generally signals risk aversion bad news for high-risk currencies like the AUD or NZD. In contrast, a falling VIX suggests risk appetite, which can drive bullish moves in emerging market currencies. Understanding this indirect influence can give you that extra layer of market awareness. Now, let's talk price action sentiment indicators. Tools like the Relative Strength Index, or RSI, can show when a currency pair is overbought or oversold. While not sentiment in the purest sense, RSI reflects how traders are reacting to price. If everyone is buying a pair and the RSI spikes above 70, you might be looking at a reversal zone. Combine this with volume, and you've got insight into not just what the market is doing, but how strongly it feels about it. Finally, we can't ignore sentiment indicators built specifically for the retail trading crowd, like position ratios from brokers. When 80% of traders are long on a pair and price is falling, it may indicate a trap. These tools help you think like a contrarian and avoid being part of the herd that gets liquidated. Of course, no sentiment analysis toolkit is complete without a reliable trend indicator. That's where the Apex Trend Indicator from FX Limit comes in. While not a traditional sentiment gauge, it does something just as valuable. It confirms the direction that sentiment is actually moving the market. Using non-repainting signals, a built-in trend scanner, and real-time alerts, Apex helps you ride momentum instead of fighting it. If sentiment is shifting bullish, Apex picks up the trend early. If the mood turns sour, it'll show that too with visual cues that even beginners can follow. What's great is that Apex supports all time frames and pairs, meaning you can combine your sentiment reads with solid technical confirmation. Say you spot a spike in greed, a weakening yen, and bullish positioning on the COT report. Apex can validate that trend and give you the green light to enter with confidence. Market sentiment is complex. It's part psychology, part positioning, and part pattern recognition. But with the right indicators and the right tools, you can turn that chaos into clarity. If you found this breakdown helpful, don't forget to hit the like button and subscribe to FX Limit for more actionable trading insights. And if you're ready to level up your Forex strategy, check out the Apex Trend Indicator on our website at fxlimit.com. Thanks for watching, and stay sharp in the markets.